Good afternoon, everyone. In the interest of time, we might get started. Thank you for coming today. My name's Cameron Kusher. I'm the Director of Economic Research at REA Group and PropTrack. The spring selling season is a really busy time of the year for the market. We know it's the one where activity ramps up. We see a lot more properties coming to the market, but we also see a lot more buyers out. And we're giving you this update today to give you some insights on how the New South Wales property market is tracking heading into spring, and also what we think might be coming down the pipe a little bit further. Today, I'll be providing an update on the market, and we'll talk about the key housing trends, look at buyer demand, look at inquiry levels, and we'll talk about what we think is going to happen from here. If you have any questions as we go through, please use the Q&A function at the bottom of the screen. We'll do our best to answer these questions at the end while we're having that Q&A discussion. So as I said, it is going to be a New South Wales market update and outlook. I'll start with an economic overview and then turn into the housing market. But first, we'd also like to do an acknowledgement of the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to the elders past, present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander people joining us today. Let's jump into the update. So I want to start by talking about the economy and how the economy is performing. So over the past year, the economy's grown by 1%. On average, over the last 30 years, the economy's grown at an annual rate of 3%. That 1% economic growth outside of the pandemic, where things got a little bit weird and we went in and out of lockdown, it's the weakest annual growth in GDP or the economy since the end of 1991. So things are very weak. On a per capita basis, the economy has shrunk for 6 consecutive quarters. That's never happened before. So basically, the thing that is keeping the economy growing at the moment is the fact that the population of Australia is ramping up so rapidly. And you can see that the main contributor to economic growth over the quarter was government spending, government consumption. So the government is spending a lot of money, which is our taxpayer dollars, and that's the thing that's growing the economic pie at the moment. As a response to the economic growth slowing, we're also seeing households saving a lot less. So the household saving ratio is 0.6%. Where it is at the moment, you'd have to go all the way back to before the global financial crisis to see it lower than it is currently. And then you've got household consumption, which makes up around 50% of economic growth. And you can see it's benign at the moment. The 30-year average rate of growth was 3.2%. It's 0.5% over the past year. So the economy is very slow at the moment, but we still have this heightened inflation. Now, we got a measure today of monthly inflation. That is an experimental measure, and it's nowhere near as broad as quarterly inflation. It's still interesting to see that headline inflation was back in the 2 to 3% target range, and underlying inflation was falling. But the Reserve Bank is going to focus on underlying inflation, and on the quarterly read, it is still way too high at 3.9%. The reason why things fell was basically that state and federal governments are offering up a lot of subsidies and rebates, which does bring down inflation. But what happens is they're temporary, and when you remove them, they're inflationary on the other side. So the Reserve Bank has said they're going to look through those measures and keep a closer eye on underlying inflation, which strips out a lot of those things. And at the moment, inflation is too high. We also got the RBA board meeting decision yesterday. No change, 4.35%. The cash rate remained on hold at, as it has since November of last year. Interest rates are still the highest they've been in 12 years. The RBA governor has said interest rates aren't likely to fall until next year. The market itself is expecting a rate cut somewhere between as early as December this year or February next year. I lean more towards February next year being the time in which we will get that rate cut. The RBA governor also spoke about how tight and strong the labour market is. So the unemployment rate at the moment is 4.2%. Now that has increased a little bit over the last year and a half or so. But to give you some context, between 2009 and 2021, there were 2 months that we had an unemployment rate below 5%. We've had 32 consecutive months of the unemployment rate below 4.5%. So the labour market is very tight. 67.1% employment participation rate. That means 67.1% of the adult population is either in a job or looking for a job. That is a record high number. But the population is growing so rapidly that we need to create about 30,000 jobs each month just to keep the unemployment rate stable. And job creation is very strong. You can see there that over the last year, the country has seen the number of jobs increase by 2.7%, which again is well above that longer term average. If we look at the housing finance side of things, we are seeing a strong increase in new lending, which is up 26.5%. Refinance lending has dropped 21.5% over the past year. Refinances are easing because a lot fewer people are coming off fixed rate mortgages, and also because interest rates have been stable for so long. If we look on the right side of this chart, this looks at the components of that new lending. Interestingly, investor lending has seen the biggest increase, up 30% from a year ago. The share of lending to investors, the overall share, is the highest it's been since April 2017. You've got lending to first home buyers, which is up 11%. And then you've got lending to subsequent buyers, so that's upgraders and downgraders, which is up 14% over the year. But it's the lowest share of lending to subsequent buyers since May 2015. In terms of new housing, there's still a lot of challenges in delivering the volume of housing we need. Under the federal government's housing accord, the plan is to build 1.2 million new homes over the next 5 years. I never thought they'd be able to do that. And construction costs are certainly one of the things that are hampering the ability to do that. So there's two components of construction costs. There's the input costs, which is the materials, and then there's the output costs like wages, actually building the thing. So input costs have escalated 34% since the beginning of the pandemic, but they're only up 1.1% over the past year. So we have seen a slowdown in the increase in those costs. Output costs for houses, you can see that they're starting to lift again. They're up 4.3% over the past year. They're up 41.5% since the beginning of the pandemic. And possibly more worrying is other residential, which is medium and high density. Those costs have risen 7.7% in the last year alone, and they're up 25.2% since the beginning of the pandemic. And all these costs get passed on to the end user. So what this is doing is driving up, relative to existing properties, the cost of new homes. Now, there's generally a premium for a new house, but that premium is much wider than it has been in the past. And as a result of that, we're seeing fewer new dwellings being approved. On an annual basis, we're seeing the lowest volume of new approvals in about 10 years. We need to be approving 240,000. We need to be completing 240,000 new homes a year in order to reach that housing accord target. And if you're not approving things, you're not going to be commencing things either. So commencements have dropped a long way. There is still a lot of housing under construction, but that's mainly because everything is taking longer to build. But that pipeline of new construction coming in behind what's under construction has really thinned out and continues to thin out. Over the past year, the population of Australia is up by 2.3%, or 650,000 people. And about 85% of that increase has come from net overseas migration. Most of those migrants are students. Most of those student migrants don't own a house here, so they're relying on the rental market, and this is creating more pressure on rents. In terms of where we think the economy is going this year, so this chart on the right is the latest forecast from the Reserve Bank, and here's just a few comments about it. So the Reserve Bank's forecasting economic growth to improve over the second half of this year, and then further into next year. But the growth rates are expected to be below the long-term average level, and I think that's reasonable. We all got tax cuts at the start of July. interest rates have been steady and they're looking less likely to rise. And eventually they will be cut, probably early next year. And also inflation, yes, it's still high, but it is moderating, which will ease some of the cost of living pressures. At the moment, government spending is the main driver of the rebound in economic growth. The forecasts are that business investment and household consumption will also pick up to help the rebound in economic growth. But household consumption, obviously, at the moment is pretty weak. We do expect inflation to moderate further, but it is likely to not, in terms of underlying inflation, not return to that target range this year, which means that we're unlikely to get interest rate cuts this year. We look like it'll be next year, but I do think we'll get several interest rate cuts as we head into 2025. The labour market, the unemployment rate is forecast to peak at 4.4%. Given the unemployment rate's already 4.2%, I think we'll be extremely lucky if that's as high as things go. As the economy continues to underperform, some of those labour shortages will wane, businesses will slow their hiring, and we'll see that unemployment rate drift higher. Wage growth has peaked. On an annual basis, wages have been growing faster than inflation now for 2 consecutive quarters, which is really positive because it actually means households are getting ahead. But if we just look at the quarterly data, the last 2 quarters, wage growth has actually been weaker than inflation. So everyone is hoping that real wage increases continue, but it's certainly not a given. Dwelling investment, the forecast from the Reserve Bank is that it continues to fall until the middle of next year and then sees a moderate pickup. That really hampers the chance that we achieve the number of houses we want to build. And population growth has slowed a little bit from its record highs, but remains at an extremely elevated level. Now, in New South Wales, some of these same metrics. So the unemployment rate in New South Wales is marginally lower than it is nationally. Over the past year, jobs have increased by 1.8%, which is bang on that 30-year average. We are seeing a very low unemployment and underemployment and underutilization rate. The number of hours worked has actually been unchanged over the last 12 months, however. In terms of new lending, so over the past year, subsequent buyer lending in New South Wales is up 16.5%. That's stronger than what we're seeing nationally. First home buyer lending's up 11.4%, pretty much bang on what we saw nationally. And investor lending is up 31.9%, which is marginally higher than the growth rate we saw at a national level. And then if we look at approvals, dwelling approvals, you can see that they've come a long way down, probably most notably in terms of apartment approvals. They were up around 50,000 a year back in 2017, 2018. At the moment, they're sitting at about 20,000 a year, and there's no sign that things are starting to improve. Maybe there's some early signs that there is a little bit of a pickup in house approvals, but we need both of those to be climbing given the state of the housing situation at the moment. And, as a result of that, commencements are very low, even though there is still a lot of housing under construction. And then net overseas migration to New South Wales has really boomed. It's boomed right across the country. But New South Wales continues to shed a lot of people to other states and territories. Mostly people leaving New South Wales end up finding their way into Queensland. So yes, a lot of people from overseas want to come and live in New South Wales, but increasingly people that are in New South Wales end up wanting to move elsewhere in the country. So let's have a look at what's happening in the established housing market. So over the past 3 months, we've seen prices in Sydney rise by 1.1%. Regional New South Wales, they're up 0.3%. On the right, you can see how that plays out across the different SA4 regions of the state. The red ones are outside of Sydney. The black coloured ones are in Sydney. Standouts have been the Central Coast, the Hunter Valley, excluding Newcastle, the Northern Beaches, and Parramatta. If we look over the last 12 months, prices in Sydney are up 5.8%. Prices in regional New South Wales up 3.9%. Most areas of the state have continued to see price increases. As a comparison, prices in Perth are up 23%. Prices in Adelaide are up 15% over the past year. Prices in Brisbane are up 14%. Melbourne prices are down 1.5%. So Sydney's seeing stronger price growth than Melbourne, but weaker price growth than those other major capital cities. And then if we look at how it plays out between houses and units, we can see both in Sydney and in regional New South Wales, house prices have seen stronger growth than unit prices. In terms of the premium for houses, across Sydney, in most regions, the premium for a house over a unit is extremely wide. Regionally, the premium is nowhere near as large. In fact, the Murray region has the highest premium for houses relative to units, which is probably a little bit surprising. But some of those Sydney markets, you can see Ryde, house prices are 3 times unit prices. They're almost 3 times unit prices in North Sydney and Hornsby and the Inner West. We are, though, seeing more stock come to the market. And this isn't just a spring thing. Our data's only up to August. For the last 12 months, we've been seeing a really strong new listing environment. So new listings in Sydney were up 4.3% from a year ago. They're up 38.5% compared to the average number of new listings in August between 2018 and 2022. You can see places like Ryde, places like Baulkham Hills and Hawkesbury have seen a really large increase in the number of properties on the market now compared to that longer term average. And then if we look at the total volume of stock on the market, it's up 13% from a year ago and about 15% higher than that 5-year average. And what this simply means is people that are trying to buy a property in Sydney have a lot more choice. There's a lot of stock on the market. Now, I understand a lot of that is not priced to sell, and a lot of vendors are being very stubborn and not wanting to adjust their price. But for people trying to buy, there is choice. But there's also that sense that even if I miss out on something, there's a lot of properties coming to the market. So we don't have that desperation that we absolutely have to secure this property because, hey, something else might come onto the market in the next few months and it might be better and prices aren't rising that rapidly. It's a very different story in places like Perth at the moment. But even though we've got more stock that's come to the market, sales volumes are still pretty strong. So you can see here that in August in Sydney, it was the strongest August any year since 2019 for sales. And they're up about 5% from where they were 12 months ago. And you can see most parts of the state have seen an increase in sales relative to last year. Looking at our measure of demand, which is inquiry per listing. So the number of inquiries per listing in Sydney was down over the year, whereas it was pretty stable. It was up 1.2% in regional New South Wales. Eastern suburbs seeing the highest level of inquiry, then followed by North Sydney, Sutherland. But pretty much every area in New South Wales has seen a decline in inquiries per listing. Maybe 2 of the areas notably where there has been a little bit of an increase is the Illawarra region and Newcastle and Lake Macquarie, where inquiries per listing are higher than they were last year. Richmond Tweed as well. In terms of how long properties are sitting on the market for, 27 days this year. It was 25 days last year. And the average over that 5-year period was 28 days. So properties are still moving reasonably quickly. But people really need to set compelling prices. And you can see in some markets, there have been quite large increases in days on market, notably in Sydney, the Central Coast, it's gone from 29 days to 44 days. You can see the capital region has seen quite a large increase as well. So for the established housing market, what's the outlook? Firstly, prices have increased a lot over recent decades. And for me, there's been 4 big drivers. At least 3 of these drivers are not likely to be as strong going forward. So interest rates at the start of the 90s were up around 20%. They fell to nothing. They're up at mortgage rates now about 6.5%. Even if that falls back down to where it was during the pandemic, which I don't think will happen, the decline in interest rates over that longer period significantly boosted borrowing capacities. Credit has become more difficult to access over the last 15 years or so. Try and take out a mortgage. They want to know planning to have kids, private school fees, holidays. No one ever used to ask that. And that does restrict some of the access you can get to finance or reduce the amount of finance you can get. And employment participation, I mentioned that that's at a record high level. A lot of that has been driven by more women joining the workforce. As more women have joined the workforce, household incomes have increased. People can borrow more. It's hard to see any of those three drivers as strong going forward. Migration is still really strong, a bit contentious as to whether it should be as strong as it is. But I think that means prices are not going to rise as rapidly as they have in the past. When I started in property 25 years ago, it was prices doubled every 7 years. Then it became every 10 years. Now it's more like 12 to 15 years. And I think we'll continue to see that rate of growth moderate. That's also a function of where prices are now. It's obviously a lot harder to double when you've got a median price in Sydney of 1.4 million for a house than it was when houses cost $500,000. Even though interest rates have increased quite a lot and remained at higher levels for a while, the demand for housing is still quite strong. Sales volumes are still good. And even though people have got a lot more choice, we're still seeing transactions happening. But that increase in the volume of stock has definitely contributed to a moderation in price because those buyers have more choice. And there's just not that fear of missing out in the market in Sydney and New South Wales like there is in some other parts of the country. So vendors really need to be realistic on their price because buyers can be a lot more selective in this market, as opposed to when you've got nothing on the market, not much coming to the market. People are willing to sacrifice a lot more under those conditions than they are in these conditions. I think the high cost of new housing will continue to see people have a preference for existing homes. And also a lot of those construction costs also feed into renovations. So people are less likely to want to do major renovations and instead will look to move. But it also means people don't want to buy properties that need a lot of work done to them. We need more infill housing. We know that the New South Wales government's trying to do this. There's a lot of political and financial hurdles that overcome to deliver that. And obviously at the moment, high interest rates, high construction costs are an impediment to delivering the volume of housing we need. And I think also the increasing cost of rent is likely to see more people that have the capacity to do it to become first home buyers, especially as interest rates start to fall. Even though it will cost them more, people will put a premium on having that roof over their head that's their own rather than someone else's. So turning to the rental market, over the last 3 months, we've seen house rents in Sydney increase by 1.3%. Unit rents were unchanged, but you can see across the different parts of the state, things are quite different. But I think what really stands out is just how expensive renting is in some of the markets of Sydney. $1,500 a week in the eastern suburbs for a house, $1,300 on the northern beaches, $1,250 in North Sydney and Hornsby. If we look over the past 12 months, rents in Sydney are up 5.8%. This is a dramatic slowdown from the 19% annual growth we saw in August 2023. So yes, rents are still growing, but the magnitude at which they're growing is really slowing. It's really interesting to me also to see where we're seeing the strongest rental growth. Intuitively, not places you would necessarily think, particularly in Sydney, the southwest, the outer western Blue Mountains, the outer southwest. I don't think I would categorize a lot of those markets as where aspirationally you want to rent, maybe, Blue Mountains. But I think what's happening is people can't afford to be where they really want to be because the cost of renting is so high and the availability has been so tight that they're pushing out into those other areas where renting is cheaper and there is a bit more availability. And I think that just really speaks to the challenge for renters at the moment. At $730 a week, Sydney overwhelmingly has the largest or the highest price to rent. To give you some context, rents in Melbourne are $570 a week at the moment. So there is a very large gap. And if we look over the past year, you can see that both in Sydney, house rents have increased at a faster pace than unit rents, whereas in regional markets, it's the unit rents that have seen the stronger rental growth. And with prices continuing to rise and that rental growth slowing, we are starting to see rental yields ease. You're probably not investing in Sydney and New South Wales real estate really for the rental return. You're looking for that capital growth potential. We are, however, starting to see some early signs that maybe there is a little bit more stock available for rent. So new rental listings in Sydney were higher than they were a year ago. Now they're still below that 5-year average. But it's also evident when we look at total rental listings. They're up 6% from where they were a year ago. Now, to be sure, they're still very low on a historic basis. but there is a little bit more availability coming into the market, which is obviously not so good for landlords that are trying to put up rents and recoup some of the increase in their interest costs. But good news for people seeking rental properties that things are becoming a little bit more available. And we are seeing inquiries per listing dropping as well. So they're down to 18.1, still much higher than they were pre-pandemic. They're down 14.5% from a year ago. And again, have a look at the areas where you're seeing the highest level of inquiries per listing. It's the outer west, it's the outer southwest, it's the southwest. Whereas you go to some of the inner city areas where you think demand would be really strong, the city and inner south, 13.3 inquiries per listing at the moment. Regionally, things are a bit different. You can see that regional rental inquiries per listing, particularly in Newcastle, Richmond, Tweed, and Illawarra, have ramped up quite significantly. Vacancy rates have jumped a little bit. They're still low. They're still much lower than they were pre-pandemic, but we are seeing as more stock becomes available that some of the vacancy rate pressure is easing. And we're also seeing that properties are sitting on the market for a little bit longer. So a year ago, a typical rental property would stay advertised on our site for 20 days. It's now 22 days. So again, if you're not price pointed, if you're too expensive, I think people are becoming a little bit more selective about what they're going to rent. So what is the rental market outlook? There's several reasons why rents have risen so much. During the pandemic, household sizes reduced. We saw a lot of share houses break up. We saw, unfortunately, some relationships break up as well. At the same time, we've had very low levels of new housing construction, and that's due to labour shortages, labour costs, financing costs. But the low level of housing construction is an important part to understand, because if you go back to 2017, when we were building heaps of apartments, a lot of those apartments were 1 and 2 bedroom stock and they were sold to investors. You look at what apartments are being built now, it's largely 2 and 3 bedroom apartments targeting the owner occupiers. That means you get fewer apartments overall, but it also means that you're not getting this new supply that's growing the rental pool. So that's creating more challenges for the rental market because you're just not getting those stock additions, especially when you've got a very rapid rate of population growth and most of it coming from migration. Rents have continued to rise over the past year, but that rate of rental growth is slowing. Even though supply is tight, we are seeing investment lifting and we're starting to see supply easing a little bit, and that should help make the market a little bit more competitive. The capacity to afford rents, though, is really the big problem. And the way people address this is they move to less ideal locations, they move into smaller properties from larger properties, or one of the big trends we've seen over the last 12 to 18 months is more and more people going back into share housing. Probably not willingly, particularly if you're a young professional, but out of necessity because those housing costs have got so expensive. So how do we solve what's happening in the rental market? Supply is imperative. And even if we fixed everything that was wrong with supply and stopping supply today, it would still take several years for that supply to show up. So the best thing you can really do is try and get more people investing in residential property, which we're now starting to see happen. And again, as interest rates start to fall, we might see even more investors coming into the market. On the demand side of things, what can you do? Well, we know the federal government's trying to put caps on foreign students. Whether they actually successfully do that remains to be seen. It's pretty difficult to implement that. You can increase rental assistance. So they've done that the last 2 years after about 20 years of not doing it at all. But lower income households are really the ones most at risk at falling into homelessness. So they're the ones that need the most support. The other thing you can do is try and assist or encourage more people to become first home buyers. And there's quite a lot of assistance and schemes out there. The problem is inflation's so high, rental increases have been so large that it's very difficult for someone that is renting to save a big enough deposit to make that leap out of renting to own their own home. But in saying that, I do think we'll see more investors coming into the market because we do expect that even though rental growth is slowed, that it's going to continue to rise. But I also think we'll see more renters exit the market. They'll be willing to pay a premium for that certainty of having their own roof over their head and not living in someone else's property. Again, especially as interest rates start to come down, I think people will have more of an impetus to try and make that move. So that brings me to the end of the presentation. We do, pardon me, have time for questions at the end here. I'll just check the chat and see if we've got any questions as yet. You can get a copy of these slides. They'll be on the Agent Marketing Center at the end, Customer Marketing Center rather, and it's webinar. So there's a question here: would there be more strata managers than property managers in the future from the influx of taller buildings and more works being done? Look, quite possibly. I think we're a long way off that. But obviously the New South Wales state government is going heavily at more density, and that would bring in more strata managers. Look, I think the move to higher density is an interesting one. I don't think most people in Australia actually want to live that way. And I think, you know, certainly in the inner city areas, there's good reason for high density, but I think medium density is much more palatable to most people in Australia. Another question here: what's the retirement market looking like and how is it affected? Now, the retirement market's an interesting one. You know, we've got an aging population. We're seeing a lot of people moving into that lifestyle retirement at the moment. Land lease is a product that a lot of developers are looking at now for those people that are downsizing. And you know, the demographics are very favorable for that market at the moment. Do I see any restrictions on Airbnb being implemented in capital cities, and what impact will this have on rental and sale markets either way? Look, I think possibly as governments try to look like they're doing more to address housing affordability and housing accessibility, I think with Airbnb, it's very localized. There's certain markets where there are a lot of Airbnbs and it will probably make a difference. But at a macro level across the whole city or the whole country, I don't think it really moves the needle dramatically. I think, you know, people are using Airbnb because the returns they can get from having their home on Airbnb are better than those they can have having it in a long-term rental pool. And it probably would encourage some of those people that own investment properties to sell if they were to do that. What's the outlook for the investment property market for the next 6 months? Look, I think we'll continue to see more investors coming into the market. You know, the returns are certainly stacking up. I think people still see a lot of upside in Sydney property prices, but I do think people will be a bit more selective about the types of properties that they are going to buy over that next 6 months. But I still think we'll see more and more investors coming back into the market. I think one of the risks, though, is as more investors come into the market, perhaps APRA, the banking regulator, looks at what's happening and says, you know what, there's just too much investment happening. We need to restrict lending to investors to give first home buyers a chance. There's no more questions at the moment, so we might wrap things up there. You know, thanks. Oh, maybe we have got one. Do you see an increase in disability purpose-built housing for rental investment, given tenants' rents are paid by NDA? Look, I think so. I think we will see that. Some of the returns for NDIS housing are phenomenal. I've seen examples, 13, 14% rental yields. So I wouldn't be surprised if we do see more of that. Another question here from Toby: what do you think the capital growth profile of the premium suburbs of Sydney will be, especially apartments? Yeah, it's a good question. In terms of the premium suburbs, look, I think they're always going to be very sought after. We do know that apartments generally don't rise at the same pace as houses, but equally, you know, the cost of some of these new apartments in the established markets is massive now, and that may actually narrow. People might actually start going, you know what, I don't need a new apartment. These existing apartments offer a lot of value. So I think it could, I mean, it's going to depend very much building to building, but I think there could be some strong growth in that premium apartment market. just the question here was the data you shared current to August or June. So all of our housing data was to August. Some of the economic data comes in at different times. So some of it was to June, some of it was to August, but all of the housing data there was to August. We might wrap up there. Thanks for joining us today. We are going to put a poll up. So if you've got a few seconds, if you could please answer that. If you'd like to listen to the session again or share it with your teams, which we certainly encourage, our recording is going to be on the Customer Marketing Center. But thank you again. Thanks for joining us. Good luck over the next few months, and we'll see you next time.